You know, one very funny thing about trading is the fact that an average trader, like from the outside, never ever thinks that something like a trading plan is a necessity. As a matter of fact, I can tell you arguably that it took me, like within the first year of my trading, I really didn't have a plan. Though even though I could lie to myself and say I know what I'm looking for in the market, and therefore I don't need to write out any plan or to sketch out anything for myself. But over time, you may be making some money without a trading plan, but I can guarantee you, without mincing words, that on the long run, you will eventually lose if you don't have a trading plan. So, an easy way to think about a trading plan is imagine you're traveling. Wait a minute. Imagine a pilot without the compass. Just a basic illustration. He may be lucky here and there. Can he even be lucky for too long? I doubt that. So, your trading plan is like your compass. The market is wild. If you've been in the market for maybe 3 to 4 months by now, you know that, okay, you actually have to find a way of navigating through a particular part in the market, but you can't just be anywhere. So a trading plan serves as a kind of a roadmap. It actually helps you to know where you're going. It's just imagine you're going somewhere, like having a specific purpose, a specific destination in mind. There's a particular saying that if you don't know where you're going, then anywhere is home, basically. And that is true because if you don't have a plan, even if the plan is in your head, it's still not valid. There's a reason why we go to school and then we take notes, right? So if it is possible for us to absorb everything that is being taught to us just in our head and then not have to write things down, imagine how much information would have been lost by now, you know. Well, that may not be a perfect illustration, but the point is that a trading plan is actually a necessity. As a matter of fact, a trading plan should be written down. If you cannot write your trading plan down, it means your strategy doesn't work. That's just the honest truth. And it's arguably so because to be successful in the market, you need a very, very simple trading strategy. And if you cannot write down your trading plan, it means your strategy is complex. Yes, and there is nothing consistent about it. But the mere fact that you can pick up a paper and a pen and then write out your trading plan or maybe scribble something down on your notepad only means that there is something about your strategy that works. But until you can write a strategy from beginning to the end without it's being so cumbersome that you may need a lot of explanation for anybody to understand, then maybe you're getting started. So again, a trading plan is just your roadmap in the market because the market is just like a vast ocean. And if you don't have a roadmap, you don't even know where you're going. You don't have a direction. You don't have a destination per se. You may have a destination in mind, but because you don't have a roadmap, it's less likely that you're going to get to your destination. So I guess I've covered the idea of what it is and then why you need one. You need one because it is necessary to guide you in this wild market that is just ready to swallow you and then absorb everything that you have. So there is no possibility of consistency without a trading plan. It has never happened before and it will not start with you, I can guarantee you. So the idea is the earlier the better. If you learn to write your trading plan and then also if you write down your trading plan, for instance, you are just like 50% off from following it. You get the point. So, if you can write it down, only means that you can follow it too. So, that is that about the trading plan and then why you need one. So, moving on from there now, I'm going to talk about the components of a trading plan. Well, you see, all this great trading plan, poor trading plan is just English language. What you actually need is a trading plan, and it should just contain, if not all of these things, but at least maybe three of these things. The first thing a trading plan should contain, in no particular order anyway, is risk management. I'm going to make a video maybe subsequently on this importance of risk management. Risk management is arguably the holy grail of trading. It is just what it is because no matter the strategy you're going to be using, there's always what we call the losing streak in the market. And if you cannot survive a losing streak, it means your risk management is poor. There is just no two way about it. There is no bad strategy. 100%. All this idea of bad strategy is it doesn't really exist. Yes, the only difference in strategies is profitability, but that a strategy does not work, it's not true. EMA crosses work, indicators work, everything in this market work, anything you see in this market work. The only thing that varies in strategies is just the profitability. I can have a strategy that has a high probability of maybe the highest profitability of that strategy is going to be like maybe 10% in a year, you know, and then another strategy can actually give 10% in a week. Yes, possibly, or maybe bi-weekly, as the case may be. So, but they are all strategies and they work, you see. So, the only difference between a strategy that works and the one that does not work, apart from a written down trading plan, is actually risk management. And as a matter of fact, I can tell you the reason why um, you may fail in trading because of a trading plan is because risk management is one thing that you're less likely to obey or to abide by if you don't have it written down. To be honest, you just can't, you don't know how powerful this is, okay? So, risk management is an essential ingredient in any trading plan, as a matter of fact, okay? So, and then the next thing that you should contain in your trading plan is entries and exit strategy. Basically, that only means that what are you going to be looking out for entries, what are you going to be looking out for exits, you see? And you have to write it down, not even with pictures, essentially. You should be able to write it down in words that, okay, fine. When the market forms a doji at this particular time or on this time frame, I'm out. When the market forms a Marubozu or a momentum candle, I'm in. Stuff like that. So simple, so straightforward, nothing more. So profit target or goals. You should be able to have an idea of how much is enough. The market can be so deceptive. The people have this notion that okay, I'm just going to let the market ride and then I'll take as much as I can take. It doesn't work that way. Yes, there are home runs. You're going to hit the home runs from time to time, but home runs is not a strategy. Well, maybe it is a strategy, but you should be ready for the many disappointments that can bring your way, because you always have this hard eye nose of, oh, I would have closed at this point, I would have closed at this point, and all of that. So, but it is better to always have a profit target. Profit target could be in risk reward ratios. All you need to do is just to be consistent with it. If you're going to be taking 1 to 10 risk reward ratio, you should ensure that every single time you're looking for that 1 to 10. But if you don't have a profit target in mind, it is very easy for you to one day wake up and take a profit at 1 is to 3, and then another day you're taking a profit at 1 is to 5, and another day you're taking, that kind of randomness. And if you're going to be random in this market, you will end up in the zero sum game. That's why they say the market is random, because it's a zero sum game rather, because it ends in zero, and all of that. So that's that about it. You need a profit target, you need a profit goal, so that this profit target tells you what is enough. It discourages greed, 100%, 100%, and then it removes FOMO, the fear of missing out, because the only reason why we can exit our a trade before it reaches our target, or the only reason rather why we will not exit the trade at our target is because of FOMO. You think you're going to miss out of something. You don't allow your trade to reach their target because you feel, oh, the market is going to reverse before it gets to that point, or you allow the trade to reverse back to your entry, haven't gotten to your target, reason being that you feel the market is going to go further, all those things like that. So, but when you can be able to have a profit target in the market and say, okay, when the market gets to this particular point, it is advisable though that your profit target should be based on risk reward, preferably, but anything that works for you is fine, but just you get the idea, just a profit target is necessary. And then pairs and trading sessions, you need to have that written down. I have a very good friend that also trades. I mean, not just one now, but they trade different pairs, you see. And I'm going to be honest with you, even when we talk about trading together, I don't even bother to open those pairs they are mentioning to me. For reasons that, of course, it's not my pair, it's not the one I want to be trading. So what's the point? If he says, okay, I'm making like 10% profit on this particular pair at this moment, I'll be like, wow, that's interesting. But I also have no, I may be losing on my own on the pair I am trading, but it's still not a reason for me to turn around and say, okay, let me even go and see whether I can also make some money off that pair. it doesn't work. So what I just do is, for discipline's sake, I stick to the pair I am trading, and then I stick to my strategy. Trading the pairs you're going to be trading is part of your strategy, hands down. That's just the point I'm trying to make. Okay, so and then trading sessions. It's important for you to indicate in your trading plan the trading sessions you want to be engaging in. The idea of writing these things down is to help you to remain, um, to maintain consistency. You see, if you are just everywhere, if you are not anywhere. You basically, if you're everywhere, you're not anywhere, right? So you just want to ensure that, okay, so this is the pairs I want to be trading, and then this is the trading session I want to be trading. Is it London session? Stay with it. Is it New York session? Stay with it. Maybe if you have a 9 to 5, it's advisable that you trade a session that is only open when you are not at work. Stuff. Those are those factors you need to consider. So having said all of these things, without wasting much time, I think I should just go straight into what my own trading plan is. Okay, first, as you may know, I actually manage funds for people, and not the conventional way of collecting money from them. It's more like account management. Okay, and this is what I do on those account management on those accounts which I'm managing. The risk I take is just 1 to 2%, which is conventional. You see, in fact, as a matter of fact, it's even advisable. Like if you are just starting out, not even risk up to 2%. One thing you should know is, well, depending on trading frequency again, one thing you should know is that 1 to 2% risk only means that, um, okay, let's say you're trading one, if you're risking 1% per trade, it only means that you are actually having like that's let's say I'm taking out commission now. Let's say you're not paying any commission, you're using widespread. So if you're using widespread and you're not paying any commission, it only means you have 100 trades. If you lose 100 trades, your account will be wiped out. If you are risking 2%, it means if you lose 50 trades, your account is going to be wiped out. So you want to adjust this based on trading frequency. If your trading plan, maybe if you're a scalper and then you have the tendency of taking as much as 10 trades per day, it is better you don't risk up to 1%. Well, you get the point, because if you're risking 1%, that means you'll be risking like 10% per day. Well, again, if you're proficient enough and then you feel you're confident enough, maybe you're a professional trader, you can do that. But then it's advisable that if your trading frequency is high, your risk should be low. There should be an inverse relationship between your trading frequency and your risk, period. Okay, so for me, I'm going to be risking 1 or 2%. It's not usually up to 2%, but I'm saying like under a very very wild scenario, I'm going to be risking 2%, but nothing more. Okay, so my entries and exits are based on 4 hour or the hourly, and then the 4 hourly support and resistance. Support and resistance is the only, well, I don't want to say the only, but it's just one of the most popular trading strategies in the market that works. Okay, so I'm not an exception. So I've been trading support and resistance ever since I started trading. All right. So, and I have traded on several pairs that I've been all through my escapade in the market trying to find my way and all of that. So I have been able to figure out that, okay, support and resistance works and it resonates with my personality without any fault. So I stick with that. Now, profit target is very important. If your trading frequency is high, well, maybe you should consider a higher risk reward. And I'll tell you why. Because the higher your trading frequency, the higher your chances of losing. That means the higher the number of trades you're going to be losing. So the safest thing is that you should have a high risk reward ratio. Maybe if let's say you have the tendency, if you're a scalper and you have the tendency of taking as much as 20 trades per day, or if you're a day trader and you have the tendency of taking like 20 trades per day, it is advisable that you take at least 1:5. You see, what is 1:2, 1:3? They are good, but they are only good for low frequency trading. Low frequency trading is where someone can argue that, oh no, if I trade frequently, I am able to make more wins and all. But in this market, you pay commissions, number one, and then if your frequency is high, there's always a day that all your frequent trade is going to just end up in losers. No matter how good it is, a day is going to come, a day or two or even three is going to come where all the trades you're going to be taking will just end up in the loser. So what are you going to do on that kind of a day? You see that kind of thing. So if you have a high risk reward ratio, it's easy for you to cushion the effects of losing streaks. Very easy. All right. So that's why it is advisable that your profits, your trading should be based on higher time frames. You see, so that you can be able to take trades that maybe you analyze on a higher time frame and then you take entries on lower time frames, like even the 5 minutes, 15 minutes, and stuff like that. Okay. So the only pair I'm trading is the cable. For those who don't know, the cable means actually GBP USD. And by the way, I've been trading gold for some time. I've traded the US 30, and as it stands now, I can trade them proficiently. The only reason why I'm coming back to cable for the purpose of the only or the reason why I came back to cable for the purpose of this fund management is because I mean, surprisingly, I make more money on GBP than gold and US 30. You see that? So all these things was possible because of journaling anyway. So I found out that GBP can give me a lot more money than the a US 30 and gold can. And by the way, at first it was GBP I was trading. The only reason why I went over to trading gold and US 30 subsequently is just because of volatility. So because I love volatility, so I felt like okay, I could trade GBP which was a volatile pair I knew then. I saw also GJ. I wanted to trade GJ, but I wasn't making any money with GJ, so I decided to just leave GJ aside. Then I moved on to what now? Gold. Gold was doing very well. Gold gave me a lot of money, even though I ended up losing so most of it. So but then US 30 was also volatile. Well, I can say that I started trading US 30 this year, and I have a working strategy on US 30, but still I am not going to be trading US 30 because I mean, for obvious reasons. If I'm going to be trading US 30, I will need wider stops, and then I really don't know. I don't want to be taking an extra lower lot sizes, even though US 30 is volatile. But I feel the only reason I'm trading cable now is because cable gives me a lot more money, and then I'm happy with the results I'm getting from cable. Yeah. So then Okay, so then the trading time, you see, another thing why I came back to GBP is the mere fact that I can trade it during the London session and also trade it during the New York session. You see that? So, well, I cannot trade US 30 or go during those times and during London session too, of course. But I feel that GBP can move, in those two sessions because the London session is for GBUSD basically, and then of course it's also tradable during the New York session. So anyway, it's just based on what I have noticed that works for me. That is why I'm sticking with GBUSD, and then I'm trading only one pair. You see that? So I'm trading 2 hours during the London sessions and 2 hours during the New York sessions. All right. This is what my trading plan is, and with this trading plan, you surprisingly, the target is going to be like to make 100% every month. Well, if you follow through, like I promised before, I have opened $1,000 account, which I'll begin trading with Monday, which is tomorrow, and I'll be sharing my results on this channel. So if you are new, I think you should like you should share this video if you think someone needs to hear about this, and then also you should subscribe most importantly so that you can always follow up on this journey. The plan for this account is to make 100% at least every month, at least 100%, and it's doable because I know my skill, and then I'm confident I can do it. So I'll see you again in the next one. Have a good day. Bye bye.